Good morning to lecturers and friends. Today, I will present on how I would invest 1 million US dollar internationally. For this project, I have selected 3 different countries. First would be the New Zealand, then Chile, and Portugal. This country were chosen because of their stability, growth opportunity, and a strong diversification across regions of the world. First, we start with New Zealand. New Zealand is known for its stability, transparency, and low corruption. New Zealand has a strong sectors such as renewable energy, agriculture, tourism, and technology. Because of its ESG focus and safe economic environment, it is good choice for a long-term and sustainable investment. Next, we have Chile. Chile is one of the most stable economies in Latin America and is the world leader in copper and lithium production. These two commodities are essential for electric vehicles and global battery demand. Chile has also had strong trade ties with major partners like the US, EU, and China, making it an attractive market for commodity and renewable energy investors. For the third country would be Portugal. Portugal connects Europe to Africa and the Americans, and it has a fast-growing technology ecosystem, especially in Lisbon and Porto. Tourism is also one of its strongest sectors, supported by competitive real estate market, and as an EU member, Portugal benefits from strong financial support and regulatory stability. Although each country is attractive, they also come with a risk. As for New Zealand, it faces agriculture dependence, China exposure, and climate risk. To mitigate this, I diversify across tech, renewables, and government bonds. Chile faces commodity volatility, political uncertainty, and currency risk. I reduce this by using USD hedge ETFs and adding government bond for stability. Portugal, on the other hand, risks include EU economic cycles, tourism dependence, and rising real estate prices. To manage this, I am focusing on tech, renewable, and use rate instead of buying direct property. As for the allocation strategy, the total capital would be 1 million US dollar, and I have divided this into 3 countries. The first would be New Zealand, 350,000 US dollar or 35% of it. Chile will receive 400,000 US dollar or 40%, while Portugal receive 250,000 US dollar or equivalent to 25% of the total capital. Starting with New Zealand, a highly stable and transparent economy, I allocated 350,000 US dollar across different types of assets. As for the short-term investment, 110,000 US dollar in government bond. These are very safe, supported by a high credit rating and provide consistent returns. 70,000 US dollar in blue chip stocks includes reliable companies in sectors such as utilities, dairy, and healthcare, while another 40,000 US dollar in a New Zealand market ETF that offers a diversified exposure to the New Zealand index and minimizes the concentration risk. This short-term portfolio targets a stable return of 4 to 6%. As for the long-term investment, 80,000 US dollar in renewable energy funds, New Zealand targets 100% renewable energy by 2030, making this a strong growth sector. 30,000 US dollar in tech and innovation stock, which the country has rapidly grown as AAS and agri-tech industry, while a remaining 20,000 US dollar in real estate REITs. This captures a long-term property appreciation and income. Long-term returns are expected to be around 7 to 10%. Next would be Chile, where I allocated 400,000 US dollar, focusing on its strengths in commodity, mining, and renewable energy. For the long-term investment, 120,000 US dollar in government bond, which provide a stability and a 3 to 4% yield, balancing Chile's commodity volatility. 80,000 US dollar in mining ETF, which Chile is known for the world top producer of copper and a major supply of lithium crucial for EV batteries. and another 50,000 US dollar in large capital stocks, which stable firms in essential sectors like energy and utilities. The expected return of this portion ranges from 6 to 8%. As for the long-term investment, 90,000 US dollar would be going to renewable energy fund. Chile is rapidly expanding solar and wind energy capacity. 40,000 US dollar in agriculture and food export company with strong global demand for Chilean wine, salmon and fruits support long-term growth. And remaining 20,000 US dollar would go to commodity linked assets, which focuses on copper and lithium to capitalize on global clean demand energy. This sector of the portfolio is expected of a return from 9 to 12%. Finally, Portugal, with a total allocation of 250,000 US dollar, balancing EU backed stability with attractive long term opportunities. For the short term investment, 70% US dollar would go to government bond. It is supported by the EU. This bond offered a strong stability and a low risk. 40,000 US dollar in large capital stocks, diversified companies in banking, utilities, and essential services. 30%, I mean 30,000 US dollar in Euro ETF, which helps to reduce the country's specific risk by investing across the broader European market. These short-term assets aim for 5 to 7% return. As for the long-term investment, 60,000 US dollar would go to tech and innovation funds, which Lisbon is one of the Europe's fast-growing tech hubs, attracting startups and global investors. 30,000 US dollar would go to renewable energy stocks, which is driven by the EU Green Deal and a major solar wind energy expansion. And the remaining 20,000 US dollar would go to rates, Portugal's strong tourism sectors that contributes to a stable real estate demand and consistent yields, which the long-term returns for this project would go to 8 to 11%. In conclusion, investing across New Zealand, Chile, and Portugal offers a strong mix of stability, growth, and diversifications. These strategies spread risk across different continents, sectors, and asset classes, making it a well balanced international portfolio. That is all from me. Thank you.